As well, with only one more trading day here in the U.S. remaining, gold is up nearly 4% year to date, one of the few asset classes out there that can say that. But in the last month, it has been up more than 7%. Are we in a gold rally, and will it roll on? Michael Pinto is back, and CNBC contributor Don Luskin is with us tonight, Chief Investment Officer for Trend Macro. And we've heard from Michael making the case for commodities overall, including gold. What about you, Don? Are you bullish on that metal as well?
I am. I think it's a mistake to throw the word hyperinflation around, but there's no question that the Fed believes that there is a great deal of deflation risk in the global economy as we've gone through this credit crisis this year, and it is countering that risk by printing a great deal of money. And that's exactly the right thing to do, because the very last thing you want to have happen is a deflation. That's the mistake that the Fed made in the 1930s. The Fed let the money supply fall 28% between 1929 and 1933. That's what made the Depression great. And this Fed is dedicated to not letting that happen. But as soon as market conditions clear up a little bit, it's going to be incumbent on the Fed to pull back some of that excess liquidity that it has put out as a fire break against deflation.
Okay.
If it fails to do that, if it is overcautious, then we are definitely going to have some serious inflation, and gold is betting that the Fed won't be deft enough to avoid that mistake.
And that's what you're betting on, Michael, I guess.
Of course. Don, we had interest rates at 1% earlier this decade. We took rates to 5.25%. And the wheels fell off the economy, because part of our legacy now, being off the gold standard for 4 decades, is a legacy of inflation. We're addicted to inflation and artificially low interest rates. So I don't ever expect the Fed will be able to take any of this liquidity back ever again in my lifetime. And let me just ask you one question. The Fed couldn't do it in 2006 if the wheels fell off the economy, and the Fed is successful in having the consumer lever up even further, and the national debt grows to 10.6 trillion as it is, and it gets even larger. Why is it going to be a good time in 2010 to start draining liquidity? Why is it going to be a good time for the consumer then, but not now?
Michael, I'm really at a loss as to why you're asking me that question.
Well, because it
sounds to me like I said that the Fed is going to have a very, very hard time draining that liquidity, and you're asking me why it'll have an easy time. I'm telling you it'll have a hard time.
Because, Don, you said it was a good idea for them to print up all this money, and I think it's a bad idea. I think we should have our recession, let the market dictate supply and demand, and the value of a bond. I see. Well, see, that isn't what you asked me, and the reason you didn't ask me is because I already answered that question. The reason the Fed has to do what it's doing now, and perhaps it's the legacy of some of those very mistakes that you quite correctly say it's made in the past, but that is the world we live in. And if the Fed were simply at this point to stand back and wash their hands of it and say, okay, well, we're just going out of the money printing business. We're just going to go back to kind of a Friedmanite, Pintoite prescription of 3% money supply growth per year, and everything will be fine. I'm telling you, with the amount of leverage that's in the system, the amount of crazy risk-taking that's been in the system, the lights of the world would go out one by one. You could put your card in the ATMs and nothing would happen, and that is too high a price to pay to go through some kind of imagined moral cleansing where we'll come out on the other side and be better citizens for it. We've got to be a lot cleverer about it than a scorched earth policy like that.
Break the tie for us, Diane.
I want to break into the love-in about gold and go back to that for a second, because I think that both of you have said, you know, it's terrific. Okay, Michael, let's start with you. If you'd invested in gold in 1981, how long would it have taken you to recover your money?
Why do you pick the bubble? If you invested in the NASDAQ in the year 2000, you're still underwater severely.
People would tend to get in when it's at its most
Okay, well, then they're in trouble.
frothy.
But if you invested in 1971, when Nixon broke the gold window, you've amortized about 9% every year. How's that? That's pretty good, right?
A lot of people out there weren't talking in 1971. They weren't even around. But I think what you have to look at is over the long term. There is still a lot of fear of deflation, and I think that some people are looking over the short term where gold's going to go. Where do you think it'll be this time next year?
I believe it could reach $1,500 an ounce sometime in 2009.
What about you, Don? Well, I mean, what are your expectations? You like gold here, but you are still expecting a continued slowdown in the economy. But when do you see the price of gold reflecting the inflation that you anticipate down the road?
Well, gold is just in an amazing situation right now. We've got this titanic tension right now that the Fed is keeping in this metastable equilibrium between huge deflationary forces and huge inflationary forces. It's going to break one way or the other. So a year from now, gold's either going to be at 450 or it's going to be at 1,500. Okay. The one place it's not going to be is at 870 where it is today.
You also have to look at the global. You have to look at the global appetite for gold too. The major buyer of gold is India. A lot of problems there. So you can't just simply look at what's happening in the U.S. market. You have to look to Asia, the emerging markets. That's where a lot of the appetite has been.
Gold is real and honest money. It doesn't care about the Indian wedding season. It responds to depreciating currency.
But weren't we in a period where gold had lost that luster, to use that cliche, and the dollar had become the safe haven investment, the perceived real currency of the world? Is that not the case anymore, Michael?
No, it's not the case at all. You know, 40% of foreign central bank reserves are in the U.S. dollar. I'm very worried about our 0% interest rate policy. If we keep up that kind of interest rate policy, foreigners may stop funding our massively increasing.
Of course, gold always has a 0% interest rate policy. And so for people to want gold, Don, as they are doing now, indicates they're gradually eroding faith in the dollar. We went through a panic in the last 3 or 4 months where people needed dollars. They needed it just to deal with their overnight funding issues after the collapse of Lehman Brothers. But now that that panic is coming off, there's the dollar's going down and gold is going up. From all-time highs in March, gold is only down 12%.
Yes.
You find me a risk asset that's anywhere near as good a performer as down 12%. Right. In this environment, down 12% is the new up.
Point well taken. We have a consensus there from the two of you, so we'll let you go at that point. Michael, Don, thank you both for joining us tonight.